Welcome to our today's class. On our today's class, we are going to be discussing about Fibonacci retracement. When we talk about Fibonacci retracement is a tool traders use to identify potential reversal levels during a pullback in the market. Markets don't move in a straight line. They move in waves. The market moves in waves by creating higher high and higher low in the case of an uptrend, and lower low and lower high in the case of a downtrend. So this is the impulsive move and this is the retracement. This is the impulsive move and this is the retracement. This is the impulsive move and this is the retracement. This retracement is also called a pullback. You can refer to it as a pullback move. So you can see the market moves in waves. So the movements in waves is what is creating this retracement, the impulse and the pullback, which is the retracement. And in that form, the market is creating lower low and lower high, lower low and lower high, lower low. So you can see. So Fibonacci helps us to measure where price might retrace before continuing the trend. That's where the price will retrace and turn before continuing its original movement of the impulsive move. So the most important Fibonacci levels traders watch are the 38.2, the 50.0, and the 61.8. But the 61.8 level is known as the golden ratio and is one of the strongest reversal zone in trading. So power line to say many institutional traders watch these levels, which is why price often reacts there. So in this video, I'm going to show you how to draw a Fibonacci correctly, because drawing Fibonacci incorrectly, that's where traders make mistakes. But in this video, I'm going to show you how to draw the Fibonacci correctly. So in the case of drawing Fibonacci correctly, let me go to the chart. In the case of drawing Fibonacci correctly, when you open your chart, you identify the swing low. You identify the swing low of that particular trend. You identify the swing low of that particular trend. So in this case, this is our swing low. This is our swing low. This is our swing low. Here is our swing low. And here is our swing high. So in this case, if you want to catch the Fibonacci retracement level in this particular movement from this swing low to this swing high, so this is the impulse move. This is the impulse move here. This is the impulse move. And this is the retracement. This is the impulse move. And this is the retracement. So in this case, if you want to catch the potential Fibonacci retracement level, you identify your swing low and you identify your swing high. Then draw the Fibonacci from the low to the high, from the low to the high. So remember, I said this is a swing low and this is a swing high. So the retracement levels will show where price might pull back before continuing the upward movement. So those retracement level I told you, the 38.2, the 50 and the 61.8 will show you where price might pull back before continuing the original trend, the upward movement. So in this case now, price came to our 50.0 level. You can see the price came to 50.0 level and pull back and continue the original trend, the original movement, which is the impulse movement. So you see, in this case, this is an uptrend movement. So the price came and the price retraced, which is pullback, then rejected on this 50.0 level and continued the original movement. So when drawing this Fibonacci, you just identify your swing low and identify your swing high. When you identify your swing low and identify your swing high on the trend, then it will show you the Fibonacci levels will show you the potential reversal level of that pullback. So when price retraces to the 50% or the 61.8 level and shows rejection, that can be strong entry opportunity. So that rejection now will be strong entry opportunity. And when the market came and show us that rejection in this level and show us a rejection in this level, you can see the rejection. It shows us a hammer candle. So when it shows you that rejection, either bullish engulfing or pin bar, which is the hammer I just told you, the hammer I just showed you that the market created in this place. So that's telling you that that market wants to retrace. Sorry, that means it's showing you that uh, market wants to resume the original movement, which is the upward direction. The original movement. The market wants to resume its original movement. The market has already pulled back and wants to resume the original movement. So you can see when you draw your Fibonacci, always look out for this candle, this rejection candle on those levels, either the 38.2, or the 50 or the 61.8. Always look out for rejection candles on those levels. So whenever price created the rejection candle on either of the levels, the market is telling you that it wants to resume the original movement. And the Fibonacci will show you your potential take profit level. So your potential take profit level is the 27.0 or the 61.8. So in this case now, if we want to catch this movement, when we bring out our short position, we put our short position. Sorry, this is the opposite. This is an uptrend, so we need to use our long position. So when we bring out our long position, we've already seen the sign of the rejection, then we'll bring out our long position, then will be your stop loss will be on the last low that the market created, which in this case, this is the last low. So you just put your stop loss below the last low that the market created, where the market rejected from. Then your take profit level will be the next high or the next resistance. But in this case, Fibonacci has already shown you your potential take profit level. That's the 27.0 or the 61.8. So you see, so Fibonacci is a very powerful tool that you use as a trader to identify your potential reversal zone and your potential take profit levels. So this is where Fibonacci becomes extremely powerful. So combining Fibonacci and support and resistance or market structure, that will give you more confluence in the market. So you see, in this case now, Fibonacci has already show us our potential retracement level and our potential take profit level. So you see, when multiple tools point to the same level, the probability of a reaction increases. So you can see this same 50.0 level is a level of what? Is a support level, support and resistance level. You can see is a support and resistance level. You can see is a support and resistance level. You can see this is a support and resistance level. So the market is going up and the market broke the resistance, and the resistance later became a support, and you see the market came back and retested that support. In this case, resistance has become a support, and the market retested the support, and the support happens to align with our 50.0 level, and the market rejected and continued the original trend. So you can see Fibonacci is a very powerful tool. So in the case of a downtrend, this example is for uptrend. So in the case of a downtrend, you just identify your what? You identify your swing high and you identify your swing low. So in this case now, this is our swing high. This place is our swing high and this place is our swing low. So you identify the swing high and you identify the swing low. So you see, the market retrace. This is the original movement. This is the original movement here. And this is the retracement. The impulse move and the retracement. So you see. So in this case, when the market is retracing, you just pay attention to the Fibonacci levels and see where the market will create rejection. So you see, in this case, the market still came to this 50.0 level and created what? Rejection. And created rejection. The market came and rejected, came again and rejected, couldn't break there rather, and came again and rejected. So on the last rejection, the market did what? It created a pin bar which is a shooting star candle. So that tells you what? When you see a shooting star, that tells you that the market wants to resume, the market has rejected and wants to resume its original movement. So you bring out your short position to your stop loss should be on the last, above the rejected area, which is the swing high. This is the swing high. In this case, your stop loss should be above the swing high. Then your take profit, look for the next support level to be your take profit. So I told you that one good thing about the Fibonacci retracement will show you your potential what, your potential take profit, and your potential take profit level, which is 27.0 or the 61.8. So in this case now, it has shown us our potential take profit level. It has shown us our potential take profit level. So you see, Fibonacci is a very powerful tool. It helps you to find your retracement, your pullback areas, and your potential take profit area. So you see, Fibonacci is a very powerful tool. So the common mistake traders make is drawing Fibonacci on small random moves. You don't draw Fibonacci on lower time frames like the 30 minutes, the 15 minutes, the 5 minutes. You draw your Fibonacci from higher time frames like the 1 hour, 2 hour, 4 hour. You draw your Fibonacci on higher time frames. And when drawing Fibonacci's, don't ignore the original trend. You first of all identify if that market is in an uptrend or a downtrend. Then you bring out your Fibonacci tool and try to look for potential reversal levels on that trend. And always make sure you trade Fibonacci with confirmation. Don't just put the two and just always look for confirmation candles like rejection candles and engulfing candles. Don't use Fibonacci without other confluence. Fibonacci is not just a standalone tool. You use Fibonacci helps you to increase your confluence, that's your increase your odd of potential reversal levels. So after drawing your Fibonacci, make sure that your Fibonacci align with area of support and resistance. So you can see in this case now, this is a resistance level. That this is a support level that now became a resistance. The market break the support level and retested and retested and retested and continued the original movement. So always make sure you use other confluence when trading, when using Fibonacci tools. Don't just use Fibonacci as a standalone tool. No, you use Fibonacci in order for you to identify those potential levels, and you need to include other confluence, like making sure that is in the retracement falls in a support and resistance level. So when after you draw a Fibonacci, always look out for 32.0, sorry, 38.2 rather, then the 50 and the 61.8. Those are the potential reversal level. If the market comes to 38.2 and you did not get that rejection candle, then watch out for the 50. If it gets to the 50 and you did not get that rejection or confirmation candle, watch out for the 61.8. So in these three levels, those are the most important level that traders watch out for in the case of reversal. So you just pay attention to these levels, the 38.2. If the market gets there and you do not get your rejection confirmation candle, then you should know that the market will still extend. If it gets to 50 and you do not get your potential your confirmation candle, you should know you should be watching out for 61.8. And sometimes it even gets to the 78.6. So those pullback when price is retracing, you just when you have drawn out your Fibonacci, just look for rejection on these areas. Just look for rejection on these areas. So those rejections are your confirmation that the Fibonacci, those levels will hold and the market wants to resume the original movement. So the original movement is what you catch. When the market resume its original movement, that's where you take advantage of the trend. That's where you take advantage of the trend. So you see, Fibonacci is a very powerful tool. So using Fibonacci, don't just use Fibonacci as a standalone strategy tool. Use it to increase your confluence in the market. So with this, we've come to the end of the class. If you have any question, you can drop your question on the comment section, and I will put out all the Fibonacci details on the description. So that's the end of the class. Thank you.